With the new Congress and administration in place, many farmers are left wondering what impact potential tax changes this year may have on their businesses and livelihoods. Roger McEowen with the Washburn University School of Law joins us now with some guidance. Thank you so much for spending some time with us in the Rural Money segment. Roger, what do you think might happen to income tax rates and itemized deductions this year? Has anything been discussed or proposed at this point?
Well, good to be with you today, Christina. That's a good question. We don't have anything in a firm legislative proposal yet in terms of a bill, but we had things that were talked about leading up to the election and have still been talked about in the new Congress. And I think in terms of income tax rates and itemized deductions, we'll probably see an increase at the top bracket level, at least on income tax rates. That would take 37% to 39.6. There's talk that the cut level would be $400,000 of income. I think that means taxable income on up. I'm not sure whether that's taxable or gross. If that's the case, then those people at $400,000 are currently in the 32% rate. They go basically to 40%. So you see about a 25% tax rate increase for them. On deductions, of course, the Tax Cuts and Jobs Act, enacted during the Trump administration, eliminated a lot of itemized deductions, but in return for a doubling of the standard deduction. And so that eliminated a tax issue for a whole lot of people on the bottom end of the income scale. But if that comes back, in other words, we revert to the lower standard deduction and return to itemized deductions, that'll bring more people into the tax rolls that were cut off under the Trump administration. So they would have a tax burden, then they'd have to look to their itemized deductions to see if those would be limited.
You know, people did get a little bit of a break on capital gains taxes. How about capital gains taxes going forward? Can we expect any changes there?
Yeah, there's a talk that those could jump and fairly significantly. And basically, given the right set of facts and the way this looks, you could go from effectively the top end currently on passive long-term gains to at 23.8% up to 43.4%. So that's an 82.4% increase. Then you add on state-level tax, and you could see cap gains taxed at about 50%. Yeah, that's a big owie right there, and that leads to planning considerations that people have to try to avoid that.
Absolutely, that's a big one to consider. How about anything about potential rule changes involving real estate trades?
Yeah, tricky one here. There's talk of eliminating like-kind exchange rules for real estate trades. Of course, TCJA has limited that provision just to real estate trades. Now there's talk about eliminating it entirely.
Wow. We have so much to catch up with you on in just a couple months before those taxes come due. So please keep us up to date each week. Roger McEowen with the Washburn University School of Law, thank you so much for what you provide.